Hello, Culture Matters podcast. Wow, am I excited about today's episode? Before I introduce our guest, here is a quote just for this episode. One bad acquisition can derail a management team for years. Adam Coffey, our dear friend to the Culture Matters podcast, a lover, a fighter, a deal maker, an advisor, mentor, thinker, audible fiend, friend of the Culture Matters podcast, probably the seventh or eighth appearance on the show, the one and only mastermind, co founder, partner of the one and only Mr. Finn, Jeremy Adams is back. And I'm in a chipper mood today.
I see that.
Because I see that. Oh, new and exciting things. Let's start there.
I was just telling you I'm gonna buy a car, so it'll be my first car in a while. There's a tax code called Section 179 for business owners where you get to bonus depreciate 100% day one, and it's the end of the year, so I'll get to take it off of my 2023 income. So although a car is a depreciating asset, and I'm typically not a fan, the math backs out to basically I give the money to the government or to a depreciating asset that has some fun component to it. So I twisted my arm to invest in a car.
How how important is that fun aspect, would you say, to this IRS opportunity? For
Yeah,
those
it,
entrepreneurs out there who are looking, towards tax season and building their businesses and
yeah. So I still am not buying like a crazy expensive car because it just doesn't align with my values. Like I don't really buy like crazy expensive flashy things. But there is just benefit of 90% of travel I just do via Uber or airplane, which is fine. But there are times when, like, even to visit you, we live around 45 minutes apart. It's somewhat difficult to get an Uber at all times. If you want to go to, again, Uber solves it, but it can be inconvenient at times. So, especially long trips, I have family in different parts of Florida, 3, 4 hours away. I have taken Ubers that long. But yeah, so I'm able to rationalize it with stuff like that too. But yeah, it's just for whatever people. I'm not anti-tax. I have been guilty of maybe focusing too much on tax savings. But if there's basic things I can do to just legally and ethically and morally not pay the IRS like this, I'm gonna do it. That has bonus of fun.
what are you getting?
Probably there's the new like Hyundai Genesis, they basically made like Genesis its own luxury brand. And the Genesis GV80 was voted the best luxury SUV. It's actually like really nice. I was just talking to my brother. He weirdly wants one too, which is really strange. We both said we wanted one. I think it's for a lot of the same reasons as me. It has a lot of the benefits and features of like a super expensive SUV, but I don't feel like I'm wasteful.
What are the stipulations to be able to show a loss on the earned income?
Yeah, I mean, it has to be over 6,000 pounds. That I believe it was a Trump tax code thing. Again, I'm not an investment or like a tax expert by any means. And I don't even know if I'm 100% going to move forward with it, to be clear, too. But it has to be over 6,000 pounds. And I guess that was just deemed as a commercial vehicle, right? So The intention was good. If I have to imagine, when the tax code was created, it was for if I'm a commercial fleet owner. It's okay. I'm just looking at if I'm a commercial fleet owner, there's a lot of benefits to um, having something like this. Uh, I think entrepreneurs got wind of it, and a lot of my travel is legit business travel. I'm going to conferences all the time. I'm going to meetings all the time. That's my role, and what I do in business is a lot of the relationship stuff. So most of my travel ends up being business anyway. But yeah, essentially, if it's over 6,000 pounds, you can bonus depreciate the entire vehicle purchase in the year you purchase it, even if you finance it over 72 or 84 months.
Really?
Yep.
And so you've surprised me here because for a second there, I thought you bought a G Wagon.
A lot of entrepreneurs, I know a few that do, and that G Wagon is over 6,000 pounds and it falls into the same category. So in theory, whatever your G Wagon you buy, a low end or a high end, 100 to 200, you'd be able to deduct that off your income in
But a
2030.
Hyundai sounds like a brilliant way to drive from point A to point B and benefit from a tax advantage. A G Wagon comes across as an ironic endeavor because of just the cost of keeping the car. I would have my assumption would be the cost of keeping a Hyundai would be far below the cost of keeping a G Wagon. And therefore, it seems as though it seems like, well, I don't know the price point yet, but it's a Hyundai. That seems like a pretty damn smart move considering, right? Because the loss for the people that do the $250,000 6K pound write downs, they end up spending tons of money on just the cost of those types of right and what those things attract. I mean, you think the lifestyle that attracts too. Not to diminish Genesis, I think that's a beautiful. I think I've seen one of those. But anyway, yeah, I like your thoughts on that because that seems like an efficient way to get the gain and not create lifestyle creep.
For sure, that's the balance I'm trying to find. And they kind of actually look like the Bentley SUVs. They're really sharp. I mean, I you because Hyundai basically broke it off and created its own brand, and that's why it's called Genesis. Genesis used to be a model of their car line, but recently, I don't know. I'm not like a Hyundai historian here, but they just made Genesis like Toyota to Lexus. Hyundai is the Genesis. So that's what it is. Yeah. And it looks really sharp and it's not crazy expensive, but it weighs over 6,000 pounds. And yeah, so it'll be a good enough car. Not going to be crazy expensive, but I'm excited to just be able to drive around. I'll probably just take it for a day trip or something.
What a win! That just sounds great. Like all the Audi drivers and Mercedes listening to this, right? Entrepreneurs may want to look at a Hyundai right now.
Yeah, I mean, I think until you're ultra wealthy, a car is probably one of the worst purchases you can make. I mean, it's like the worst use of capital. And I've been guilty of that. I had some really nice cars in my mid 20s when I, looking back, if I would have, I think we even talked about this on the last show, but if I would have done anything with that money, it would have been a better use. But you live and you learn. And now I wouldn't be doing this if it wasn't for the tax incentive. But that's again, it's the math comes out to basically you're paying the IRS or paying for this depreciating asset. So,
If you were to put that tax savings into your IRA today at 10% return, what would it be in 40 years?
well, you can't put it in your IRA because the car will end up being about 70,000. So let's just take about a third of that in Florida is what my taxes would be. So what's that about
21.
24
Yeah.
or about
Yeah.
24, 23 and change, a third of 70. So yeah, I mean,
Oh, 33%, not
so,
30%.
so basically what it's doing
Got
is,
it.
yeah, yeah. Basically what it's doing, I could put that 23, we'll call it, in whatever I want. Um, and then the other components of the car are still business expenses too, like the business related gas, the insurance. So there's other business expenses that go along. But yeah, essentially I'm just holding on to that cash now, the 23 and change, instead of giving it to the IRS.
So okay, got it. But in theory, because less is spent, that money is kept.
Correct. And I've been pushing myself to be really uncomfortable and lowering my cash on hand amounts and investing a lot. So that's probably what I'll end up just doing with it. Just like you said, it won't be a retirement account. It would just be probably just a traditional account and just move it into the market.
For those that are not familiar with the buy not build philosophy, what's your take on it?
Well, all I've done is build companies, so I wouldn't be the best person to ask, but I believe that's the next phase of our entrepreneurial career, which you're saying buy a business, not build a business from scratch, right?
Yeah, there's this movement. It seems to be for been fermenting in the entrepreneurial community. Buy not build. There's a book. I don't recall the author's name, but buy not build. Various influencers are espousing the value of
Yeah,
buying,
I mean,
not building.
in theory, it makes a lot of sense. My phone thought I just said in Siri, so it just turned on. But in theory, it makes a lot of sense because most startups fail. Mine are not exempt. And even if they don't fail, they're really hard to get off the ground, figure out the business model, hire the core team, figure out top sellers and how to maximize value out of a customer. So even if a small company has a lot of those core things figured out, there's a lot of that makes sense why this is so popular. Now there's a lot of rhetoric in the entrepreneur sphere about no money down purchases and just super creative things like that. I I get a little skeptical of that only because of the same thing you've talked about when somebody wants to give you equity in their business, they're saying their business is worthless. If you're able to get a business for zero money down, like I will say there's exceptions. If there's like a clear, I can 5x your business and we can put it in writing and it plugs in right into the like if there's a clear strategic fit, there may be some exceptions, but to just create this uh norm of you're able to just buy businesses with zero money down, it's probably possible, but these businesses aren't going to be much different from a startup. And they actually could have uh, a lot of liabilities associated and baggage, right? So, again, I'm not saying you can't find good businesses with no money down. Just think about if you were a business
An
owner.
interesting paradox.
Yeah, if you were a business owner, in what cases would you be willing to sell for no money? You built this business for 20 years, you've dedicated your life. Sure, I'll hand the keys over. Do you want any money down? No, don't worry. Again, I'm not saying it's impossible, but it's probably some distressed asset or, yeah, again, that's my opinion.
This I want your thoughts on this. I think there's a paradox of IP here because okay, the person let's say there's a correlation. It's not a cause. It's not 100% causal, but let's say there's a correlation between having the money to buy the business and knowing what to do. Meaning, how did I get money? Well, there's a likelihood I got it from doing something that worked. So the person that knows what to do why would they want to give up the most expensive piece, which is equity, when they know what to do, because that's their return. What I mean by this is the person that knows what to do. I think there's a correlation with the person that has the experience and knows what to do in having capital, and they want to get the biggest return on their time, their intellectual property, their capital. And if they're getting it with no money down, what that really means is there's just more partners involved, that's whether there's just more partners involved. Debt is a partner, it's a bondholder. Equity is a partner, it's an equity holder. So somebody that, yeah, I think there's a paradox in there. Like the person that really knows what they're doing would want to get the biggest return possible on what they're doing. They're not getting their time back. So if they have money and they know what they're doing, they'll want to use money to get the business. They'll want to have less partners. They want to give up less equity, because equity is the most expensive debt. Meaning it has the greatest likelihood of having the highest return. So I
I'm
think
just
there's a paradox in there that there's exceptions, right? There's people that don't have any money that may know what to do. And
distressed. That's what I'm saying. It's the same thing with real estate. It's like you see these deals. It's like I bought a property on foreclosure for 50 grand and put 30 grand of rehab, and now it's 200 grand. It's like it's kind of the same thing. It's like there's stories out there and that's possible, but you just, I guess, if you're really good at finding distressed business assets,
well,
because
my point is though, whether it's distressed or not, the more OPM used is the less return for the person that's fixing the distress, is my
yeah,
point.
maybe so, and that's okay. I mean, like that's, I think I'm like early, I'm new money, so I'm early into starting to build my wealth, and that's what you do when you're new money. You use other people's money. Even maybe as I grow, I'll use less of other people's money in certain cases, but other people's money may be the only route for vast majority of business owners. So that's
No,
okay.
no, and I'm not discounting that, right? New money, upward mobility. What I'm discounting is old people espousing great tenure and big experience, promoting the idea of them using none of their own money. To me, that represents charlatan, because when you're old, the proof that you weren't a fool is you have money, you have assets, you have things that you do yourself. Example, you don't see Warren Buffett buying these companies with other people's money. He's buying it with his money, the money that he's saved up in his business. The one business, he only owns one business. It just so happens that it has holdings in many businesses that are wholly owned by it. That's what I'm saying. So I don't want to, I'm not discounting you or the younger listeners listening to this, or any of us that are going up the ladder, right? I'm saying be careful of the older people espousing and almost bragging, or um, enthusiastically, pridefully ar- articulating with strong rhetoric the value of OPM. Uh, I think that's correlates with BS. Now, there's exceptions to rules, but I think it correlates with BS, and I think that those that prescribe to their dogma are likely the product, not anything to
I
do.
mean,
They're more educators than they are
return
practitioners.
aside, yeah, return
Yeah.
aside, just I could see just the amount of extra headaches using other people's money compared to using your own money. So you're sacrificing on the return, which you're touching on, which is if you're, truly made it and it's a small deal, that is definitely a red flag if they're trying to use other people's money. Small deal proportionate to their alleged success, right? Um,
Here's my point. Wait, especially if, because there's an exception to that, like if I want to build a business, my shareholders are my limited partners. They're my investors. But if I'm telling you that this is not a business, it's passive and it doesn't take a lot of work, that's BS. Because if somebody is using their own money, um, or I'm sorry, yeah, it's work no matter what. If somebody has, for example, a family office, a single family office is a team of um, employees and contractors that are living on a P&L based on the principal. There's enough principal, there's enough money, working capital that's funding that enterprise. It's a business of money. It's the business of investing money. So like somebody that's saying to do OPM and that it's passive or something along those lines, like do less work, make bigger return. I believe that is they're high on their own supply or just straight up full of it because somebody has to work essentially. And if we have investors, we work for the investors the same way we would be working if we had investors for our like retail business or whatever it is. Like the LPs are our investors. We work for them because they're fronting the money and we have to get them a return on their money. And and if we don't get them a return on their money, let's say it's a bond, like they've loaned us money. Well, they can take the freaking business. They'll get paid before equity people because we promised to pay. So that's what I mean. I just to add something into the pot there. Whenever we see, basically passive and OPM, I think that's a red flag.
that's interesting. Yeah, I just go back to, of course, there's exceptions, but why would anybody in 99% of cases let their business go that's worth something? Whether it's some sort of cash flow, IP, real estate holding, something, why would they let that go with like a crazy discount or even zero cash down? Um, that's, I think, what I was referring to. We see
Oh
a
yeah,
lot of
yeah,
that
yeah.
online.
I think it desperation would be one,
Yeah,
especially if they
stress.
haven't
That's
seen a
what I
track
mean.
record. Yeah, okay, yeah.
The stress. I would say like another scenario could be uh, the opportunity, though, is probably the acquirer sees more value in the company than the seller, is another reason why they could get it with very minimal capital. Like there may be an e-com property that is just doing nothing, um, sitting on a bunch of inventory. They basically just chalked it off as a loss because they could not make it work. But they're like, hey, if I plug this into our team, our marketing team, our customer service team, can I just like, you know, pay you on growth? If, like, so there's examples like that. But I guess like the acquirer would need clear value and I'm just thinking through this in my head. The combination of adding a bunch of value to the deal slash this person just has such minimal value of like what they own or lens or perceived value.
I got another one to throw to you to see what you think. Like, I want your feedback on this. A strong founder has the ample amount of self deceit, delusion of grandeur to believe their company is worth more than it actually is because there are negatives to this. There's also really good positives to this. It's that type of attitude that's tied to a vision of where it will be. Right. So let's say the earnings are 4 million a year and based on comparable sales, it'll get a 4 multiple. So it's valued from a financial audit standpoint at 16 million, 4 times earnings, right? A strong founder is going to be like, no way. It's worth 32 and this is why. because I do this every morning, I do this every night. I don't
You're
do
saying
this.
it's a bad founder if they're willing it to let it go for lower. That's the opposite.
Let's just say they could either be, let's just say they may be, depending on their behaviors, they may be missing an element of, so there's healthy pride and there's neurotic pride, right? There's pride based on past performance, and then there's pride based on arrogance as a result of insecurity, like idealistic pride.
I
So
see.
we want to differentiate between the two, but I do want to say that I think it's a red flag. It could be a red flag in either way. The person that is willing to give it all up, they may not. How the hell are they going to sell any customers? I guess that's an easy way to say it, right? They don't even believe in selling their own damn business. So I don't want to attract people to me that want to just give up their shit. Now, if they think I'm freaking the prophet or something, right? Like, I guess the real like a shark, it's different because that could actually make people's ego go down momentarily because they think like I'm the solution. I guess this is where branding comes in for any
Yeah.
buyer, right? For buyers. But what are your thoughts on that? I think there's a connection there psychologically that's important to unpack.
Yeah. I mean, there's a lot to unpack there. It's when you're not putting any capital, I think it's no matter what's in the contract, it's implying that you're kind of going to take over the whole thing and they're because the founder has basically zero incentive to be involved at that point too, because so they're basically handing over the keys and you're just no matter what's agreed to in the deal terms, you're symbolically responsible for the success of the business. When because we've been involved in some deals like you're talking about, where or like we're talking about, and we've given equity back because the businesses were just so bad it became a drain of my time. I just dreaded getting on calls with these people. They just looked at
Wow.
us for everything. So I think when you put cash into a business, you can dictate a lot of terms and how things are going to go, what the capital is going to be used for. When you don't have that, you just lose a lot of leverage too.
What do you
And I
see?
just
Oh,
again,
go
I
ahead.
think subconsciously, like Max and I have talked a lot about this. When you're putting capital into a business, it's kind of it's showing the partners or the founder or whatever, I'm an investor, not a operator. But if you're not putting capital in, what else can you be except in theory than like an operator? You're gonna be an advisor and take over their whole company. You be you're taking over the job of operator. So yeah, I guess the short version of it is there is possibility here if you're great at negotiating and finding these distressed assets, but I don't think it's something the typical person that wants to acquire a business can successfully pull off.
Yeah, I think our listeners need to be wary of the people that are offering the panacea, the solution to all problems without skin in the game. Because, and by the way, the skin in the game, if they're going to be the operating type that gets equity, well, then if they're really competent and they have a team behind them and they're willing to get their hands dirty, that could lead to serious results.
There's nothing wrong with consulting for equity type of stuff. I just think I've learned from some bad deals and some friends that I trust that have done deals. When it's a consulting or advising for equity, so now we're talking about maybe buying a piece of the company, the smaller percentage of the company you take, really the better. Because it's, I've heard people tell me dumb things where they're like, hypothetically take half the company for me just giving some advice and being a strategic visionary. And it's like, again, the more you take, you're just symbolically saying you're going to be an operator. Whereas,
Well, oxymoronically, not because talking at somebody and then or is different than getting in the trenches and implementing various processes,
yeah,
systems, making sales, bringing things to the table. Consult for equity in our culture today is like, I'm gonna talk at you into your success. I'm gonna hold you accountable. I'm gonna be your and ultimately, I think that's a fugazi.
Yeah, I don't think it is because like with one of our businesses that we're involved in, we look for a specific avatar. That's a very unique avatar of customer, and they're hard to get to. So if someone said, "Hey, if I can achieve these deliverables, bring you to these people, could I potentially earn this profit share or possibly even ownership in the company?" Like as long as it was clearly ironed out and we felt good about it, that's something we would have openness to, but there would be strings attached and there would be a cap on that value because if we gave up too much as operating partners, I
Well, rev
think,
share based on KPIs would make sense.
yeah, rev share, but I'm saying depending on certain targets being hit, I think there would be openness to ownership if it was the right deal. So I'm not saying what I'm saying is consulting for equity can work, but I think there would be a lot of contingencies on our side. I'm just thinking from the business owner lens. You're saying it's a fugazi. I don't think it
Higher
is.
probability. If there, yeah, no, I'm saying that the people that I'll give you an example. Let's say that I have a really strong personality brand, meaning I have influence. People follow me. People admire who they think I am. I mean, and that's really what a brand is. It's a belief uh, um, in X to solve for Y. Right? X is under the observer's conscious perception. Y is the observer's conscious perception of their problem. The brand is the belief in X to solve for Y. So let's say I'm the personality brand. I'm X. I have 10 million followers in the world and a body of perceivable data information to represent to the observer that I'm credible, I'm an authority, and I can get a result. That belief is naturally misconstrued as trust. But trust is actually played out over a series of interactions. Meaning you personally have a relationship with me in the actual physical world outside of this podcast.
We have a physical relationship.
So I've had all these years of our physical relationship for you to say I trust Jay or I don't trust Jay in different contexts because you've seen me in the physical world give my word for something, like say I'm going to do something and then do it or not do it. Where I'm going with this is if I have a big brand and I have followers that have a certain pain point that I'm speaking to, if I have enough followers, I can get 100 deals in the pipeline of consult for equity, which depending on the expectations, it could just be share information for a piece of an outcome, right? And if I have the more people I have in my
Authority,
pipeline,
authority too. I think if you build your brand big enough, there's value to just an authority figure. Yeah.
so in essence, where I'm going with this is it can create a a subconscious incentive to the pundit, to the authority with the brand to not go all the way to increase like do everything possible as an authority, as a leader to increase the likelihood of the customer satisfaction. The
I mean,
customer satisfaction would be the outcome of the person that's giving
I,
up that equity.
yeah, I
The
don't know if
customer
I
or the
agree
customer.
because
They
I
can
think the
easily replace
problem,
it.
yeah, I think the problem in a nutshell, there's a lot of deals where people get minority equity ownership, whether it's for cash, consulting, some combination. I think it's just a matter of experience in both parties to structure a deal that doesn't build resentment, being able to talk about things. Yeah, I mean, because my
A
first
lot of the
company,
time, those smaller companies, what they really, this is where I'm going, what they really, the paradox is they're not willing to invest in the advisory or get the help that they need.
so they give up their equity.
So they give up their soul because they don't value themselves in the first place to get the help they need, which just costs money,
I mean,
or
there's
they
small
overvalue themselves because of their arrogance.
there's smaller publicly traded companies that lack cash, but their stock has real street value that they're willing to give stock for consulting or board seats. I mean, it's very common and like,
Yeah, well, yeah, I'm making an argument for the increase or decrease in likelihood of success, not making an argument of whether things happen or not happen.
yeah. So what you're saying though, if you're super small, both parties are taking a big flyer, anything that you can do to take equity and motivation away from the founder just stacks the odds. Is that what basically what you're saying? It's just one less reason for them to already
Or
like,
I'll say it this way: if I want to get if I'm the investor, I want to get the biggest return possible. I want to be partner with people that don't need me but want me. They don't need
we're in
me, but they
agreement,
want
and
me.
that's the deals that make sense. Is
Yeah.
as the person wanting to do the consulting for equity, be the advisor, the consultant. I think that's probably the key is finding those deals that they don't need you.
It kind of reminds me of Charlie Munger's quote on marriage: "If you want a good spouse, deserve one." So, as the investor, to deserve a good spouse, a good partner, I've
Yeah.
got to be a good partner. And if I have 1,000 people in my pipeline, my incentive, unless I'm really self-aware and have a clear criteria of what I'm going to say no to, I'm incentivized to just do deals and convince myself that everybody sucks and it's their fault that they're failing, not me as ultimately the CEO of their company, because I'm the CEO of the CEO in that case. I mean, I'm the
You
chairman.
don't, yeah, you don't want to be the, as the consultant for equity, advisor for equity, you don't want to be the golden ticket for their success. Yeah, like,
Maybe to clear this up a little bit too, even if someone's, let's say, investing cash, they're a capital partner. It's not just the cash that they're giving, it's cash and IP, right? It's cash and some type of, or else they're just a money lender essentially with you're getting a higher rate of return. Meaning, if I'm giving money and I'm not giving intellectual property, that's called a bond. It's like I'm giving, it's a loan. Take out, sell some corporate bonds at a fixed rate of return. But if I'm giving up equity, um, I think implicitly it connotes this, or it infers, or is a call to action for the investor to be more than just a money lender. I'm curious.
yeah, that's what I'm saying. You're basically involuntarily uh stepping into an operations role. Yeah.
Yeah, like if I'm gonna be partner,
Again, it just comes down to experience. So we're
yeah,
kind of going down a rabbit hole here. I think consulting for equity deals can work. It's just I don't think most of them can work. I think we agree on that.
yeah, yeah, I don't even see this. Yeah, I don't see anything. We're just speaking at different resolutions of this, right?
Yeah.
Here's
Turning
something to
my
throw.
head. Transparently, Jay, it's turning my head a
Yeah,
bit.
well, this is why the M&A guys make millions of dollars. It's definitely not, but it's becoming more and more accessible to everyone. That's another thing. A lot of this is operators don't have access to this information, so they get taken advantage of by the Jordan Belforts of the world, right? They get the cold call. The person from the Goldman Sachs is asking this question, asking that question, telling this story. And before they know it, there's so anyway, just something to think about. Yeah. I think work works essentially.
Yeah.
If I sell parts of my company to people that don't want to work and are hoping that I become the slave class of their capital, I think that partnership is going to end in oblivion no matter what.
Jay, I was actually gonna wait till the end of the call, but we can do it now. I wanted to discuss our advising for equity deal for Culture Matters.
Yeah, no, if I'm coming across as though I'm not all for that, oh no, that's not my intention. It's how the relationship, right, starts and continues throughout, like that's where more so for the audience to be privy to these things. I'm totally pro um value, because that's what we're talking about right now, right? What is equity? It's value, because value is time and
Equity in most businesses is worth absolutely nothing because most businesses go out of business, or most businesses are barely staying in business enough to just pay the key operators, whoever key employees that are running it. And equity in most companies is just worthless. Like that's what I've been fortunate and unfortunate enough to learn the last decade is sometimes equity you don't want to come to, like some of the deals that we structure, I'd rather take the cash because maybe I don't have a lot of confidence in what they're doing, or I just don't want the responsibility of being an equity owner. And that took a lot of time and bad deals to learn.
hey, what do you think you would what type of person would stick out to you as someone that you would take that risk on? So, in the train of thought, equity can be a lot of headaches. It doesn't have value until it does. So, what type of person, operator, would you take that bet on if you were to break down their characteristics? Um,
This person would be a visionary by themselves, already achieved some level of success, be financially stable and just fiscally responsible. I think those are big ones. We have a performance agency and we tell people we want to be early, but we don't want to be first. I don't want to take bets on someone's first success. Now, if they weren't extremely successful, but they did okay, that's still okay too. Like maybe they haven't crushed it in business as an entrepreneur before, but they worked their way up the corporate ladder or crushed it in sales and they earned three or $500,000 a year at some point. Like so they've had a taste of success. I got involved with some deals with people, honestly, I don't think were ever successful. And again, that's subjective. So success could look different for every person. But for me, it's just they've had some track record of financial success and they just want something bigger and better for whatever reason. That's a big one.
three, so visionary, some level of success, fiscally responsible, and four, not first rodeo.
Yeah.
Jeremy's criteria. How about four things that are the game's over? Get the out of my office.
Um, what's the opposite of fiscally responsible? Fiscally irresponsible?
Boom, that's one.
I mean, no, just the looking at me as some golden ticket. I touched on that earlier, but if they need me, you touched on that too. If they need me to reach this goal or success and basically the doors are going to shut or without me, that's huge, huge red flag. I personally value people that uh, are humble, that live private lives, because then I know, and we talked about this maybe on the last episode, but I know they're doing it more for themselves, not for the perception of others. For me, that's important.
That's good. So three more red flags. I got fiscally irresponsible. If they need me, overly dependent upon, not good.
You want one more?
Yep.
Let me think. Um, Companies that don't have a plan to extract additional value out of their customer base. So like we call it in the e-com world lifetime value, but they don't have a way, whether it's subscription or selling them other products that they could benefit, or if there's not a plan to sell and generate more revenue from a customer after their first purchase, that's a big red flag too, because successful companies need that. And if they haven't even gotten clarity on what that is going to be for their business, you don't even know if it's going to be a successful venture yet.